This video is called Can Business Investment Be Revived? One of the puzzles of the current recovery is why low interest rates have not been able to lift business investment. And so we will examine this issue, put it into perspective, and show why this is happening. This is private domestic business investment on a log scale going back to 1960. You can see that the pace of growth in investment began to change around 1985, and so business investment has been growing at a slower pace for the past 30 odd years. So point number one is that slower investment growth is not just a recent phenomenon. This is what business investment looks like as a percent of GDP. You can see it generally ranges from between 10 and 16%, but pre-1985, it was generally above the average line of about 13% most of the time, but since 2000, it has been mostly at or below that line. So when you hear about investment, it actually comprises two components. One is called capital consumption allowance, and the other is new investment. Capital consumption is like depreciation. It represents the amount needed to maintain as opposed to grow the assets. And then new investment is exactly what it is. It just represents new productive assets. This chart shows each of these on a per capita basis. Note how capital consumption keeps trending up, but new investment on a per capita basis has been mostly flat since 1985. And then this is the key chart. This is very interesting because you can see that capital consumption as a percent of GDP is basically stable at around 11% since 1985. But the red line, which shows new investment as a percent of GDP, has actually been trending down since 1965. So we are now down to about 2% of GDP in terms of new investment. This chart shows how total investment tracks GDP. Growth is what drives investment. When you have growth in the economy and companies are doing well, that is when they need to increase capacity or have new products. And so that drives investment. This is the same GDP growth against just new investment and also highly correlated. The point in showing these last two charts is that real GDP has also been trending lower and is now sub 2%, and we expect it to be around that level for the next 10 years. The next observation is that we are seeing lower rates of capacity utilization. Capacity utilization has been trending down since the 1970s. The blue line shows capacity utilization. Each of the peaks is lower than the previous peak, and the red line shows that new investment as a percent of GDP tracks that pretty well. So we are just not utilizing the assets to their full potential, and there is no need for new investment. And that is highlighted here if we look at GDP divided by the productive asset base of non-financial corporations. You can see, especially in the past 5 years, it's troublesome. It's at a level that almost always is consistent with being in a recession. So that is a troubling sign. This is just gross value added of non-financial corporations relative to assets at historical cost. And you can see we are just getting less and less productivity from existing fixed productive assets. The need for additional new productive assets is just not there. We have enough productive capacity and we are not turning over the existing assets properly. And then in terms of new investment, today's information-based industries are capital light relative to manufacturing, so the costs to start a tech company have declined exponentially. And you're seeing companies utilize existing resources more efficiently as opposed to building new resources. Companies like Uber and Airbnb are now large companies, but they haven't invested anything in new physical fixed assets. And so putting all these factors together, you have real GDP growth rate that has slowed compared to what it was historically and is likely to remain low at sub 2% levels for a while, which leads to lower new investment. Second, asset turnover and capacity utilization have both been declining for a long time, and new investment relative to GDP has logically been declining too. And even though we are adding a little bit of new investment every year, it's still probably more than we need. In terms of new investment in existing industries, we have plenty of capacity, we just don't need new investment. But where we are likely to see new investment is in new industries where capacity does not exist. And so that is where the growth in new investment will come from. But like we said, a lot of the new industries are capital light relative to the old manufacturing type industries. So based on all of this, we expect a continued decline in new investment relative to GDP, and we don't see that changing for a while. The most likely fix for the time being is that the government step in and bolster investment with an infrastructure package, as a lot of people have called for. So thanks for watching. That's it for this video.